Good morning. As the American economy struggles to regain its footing, we're going to spend a great deal of time this year as a subcommittee exploring both the obstacles and opportunities for job creation. Today we'll hear from a respected panel of experts who will join us in a wide-ranging discussion about employment trends in America and what factors are driving and shaping these trends. I also want to thank everyone here for your ongoing commitment and efforts aimed at creating new economic opportunities and new jobs for Americans. And now the Chair recognizes herself for an opening statement. Last year, when I became chairman of the subcommittee, I encouraged all of my colleagues to join me in an effort to make Made in America matter again. Well, today we're actually starting to see a renaissance of sorts in manufacturing, with companies like Caterpillar, General Motors, Master Lock, Solder Furniture, General Electric, Ford, and many other companies all bringing jobs back to the U.S. But is this trend sustainable, or will jobs return to America in dribs and drabs instead of droves? This is the first in a series of hearings we will hold this year, looking closely at ways to stimulate job creation and economic opportunities. I believe we have a window of opportunity, but it could close on us quickly if we don't take action. China's overwhelming manufacturing cost advantage over the U.S. is shrinking fast. Within 5 years, a Boston Consulting Group analysis concludes that rising Chinese wages, higher U.S. productivity, a weaker dollar, increased trans-Pacific shipping costs, and a variety of other factors will virtually close the cost gap between the U.S. and China for many goods consumed in North America. This is our chance. In fact, the best chance we've had in decades to make Made in America matter again. But to be successful, we must remove the roadblocks and barriers businesses are facing today when it comes to job creation. Embracing tax reform, regulatory reform, and tort reform are just some of the things that Washington can do to help jumpstart real job growth in America. But here's the good news. Data issued by the Bureau of Labor Statistics shows a recent uptick in monthly job creation, with the jobless rate declining to 8.3%. Now here's the bad news. To date, we've had 36 straight months of unemployment above 8%, the longest such streak since the Great Depression. Today, too many people are still suffering. That's why we need to work closely together to create forward-looking policies which will create economic growth in America, not stifle it. Clearly, the lack of job opportunities remains a dark, ominous cloud over Main Street, USA, with the average duration of unemployment for job seekers lasting more than 40 weeks. The bottom line, unemployment today remains stubbornly and unacceptably high, with nearly 6 million more unemployed workers right now than there were just prior to the beginning of the recession in 2007. Additionally, many economists suggest this number does not, in fact, represent the true unemployment rate. After factoring in the number of people who are underemployed, such as part-time workers in search of full-time employment, and those who have completely given up hope and exited the job market altogether, the Bureau of Labor Statistics reports the effective unemployment rate stands at a staggering 15.1%. What's more, in comparison to recent recessions, the rate of our job recovery this time is much weaker too. For instance, at a comparable point of the recovery from the 1981 to 1982 recession, the U.S. economy had added 6.2 million jobs above pre-recession levels, a growth of 6.8%. Yet while the U.S. economy added nearly 2 million jobs over the past year, the employment level today reflects a net loss, with America's non-farm workforce approximately 4% below pre-recession levels. Today, industry experts are divided and see things differently when gazing into their crystal balls. The Boston Consulting Group, which is testifying before us today, projects the U.S. has the potential to add up to 3 million new jobs in the manufacturing sector alone over the next decade. The chief factor in support of this upbeat forecast is a decreasing cost advantage of manufacturing in China due to the rapid rise in Chinese wages. On the other hand, a study recently conducted by the Harvard Business School involving nearly 10,000 graduates reveals a more pessimistic view, a sense that America has a deepening competitiveness problem. At the heart of this viewpoint is a sense that our nation is falling behind in fostering an environment conducive to job creation. The U.S. tax code, uncertain political environment, a burdensome and sometimes unpredictable regulatory regime, a declining education system, and the lack of a skilled workforce were cited as contributing factors to this dreary assessment. So as we examine the data and analyze the trends, is the glass half full or half empty when it comes to our future? While I'm a big Clint Eastwood fan, I don't buy the idea that it's halftime in America. I think we're in the fourth quarter, we're still trailing in the game, and we need to drive the length of the field to win. That will take great teamwork and a smart game plan. But working together and for the good of all Americans, I know that we can do just that. And with that, I'm now handing the ball off to the ranking member of our subcommittee, Mr. Butterfield of North Carolina. Mr. Butterfield, you're recognized for 5 minutes.
Thank you, Madam Chairman, for holding today's hearing, which I understand is going to be the first of several job-related hearings our subcommittee will hold this year. There is no more important issue to working Americans than the ability to get and keep a job, provide for their families, and ensure that when their children grow up, they can succeed too. The causes of the most recent economic recession are many. They are certainly complex. While the solutions can also be complex, one thing is certain: the creation of jobs benefits the entire American economy, and in recent monthly employment reports, we have begun to see the fruits of that labor. But there is still much work to be done, and I agree with the Chair on that. On day one of his administration, President Barack Obama inherited an economy in the worst shape since the Great Depression. A tremendous national debt was inherited, a crippled manufacturing sector and auto industry, and he became the commander-in-chief of not one but two wars in the Middle East. Just 3 years ago, 3.6 million jobs had been lost. Businesses were eliminating more than 700,000 jobs each month. By March of 2010, we reversed that course, and by the end of 2010, American businesses would go on to create more than 1 million net jobs. But with the national unemployment rate at 8.3, much more still needs to be done to return us to full employment. One of the keys to returning America to lasting prosperity is education. However, the cost of college remains a major barrier to those wanting to attend, and those barriers are particularly acute for minority citizens. In a June 2011 report by the College Board, the cost of college was cited as one of the biggest roadblocks to gaining an education. The report finds that in order to regain the nation's once preeminent international position in educational attainment, we must begin to matriculate and graduate populations of American students who traditionally have been underrepresented at the post-secondary level. Only 26% of African American men hold at least an associate's degree, compared with almost 50% for white males. Those numbers are reflected in current unemployment statistics, with 13.6% of African Americans unemployed, compared to 7.4% of white citizens unemployed. I am encouraged by the President's 2013 budget proposal, which includes $8 billion for community colleges to help train workers in high-growth industries. The President proposed the creation of a new community college to career fund that would be administered by the Department of Labor and Education. This effort could lead to over 2 million unemployed Americans finding good-paying jobs, paying into the system, and help to reduce the debt. The Bureau of Labor Statistics report on employment for 2010 through 2020 projects that 20.5 million jobs will be created over the course of the decade, many in industries requiring significant education or training. It is therefore imperative, Madam Chairman, that we invest significantly in these areas in order to build the strong workforce necessary to succeed in an increasingly competitive global economy. And so I say I look forward to hearing from today's witnesses, and thank each of you, each of the four of you, for so graciously coming today and giving us your time. Thank you very much. I look forward to the testimony.
Thank the gentleman. And in accordance with committee rules, Chairman Upton has yielded his 5 minutes to me, and I will yield the first 2 minutes to Ms. Blackburn of Tennessee.
Thank you, Madam Chairman. Welcome to our guest, and I think we all welcome the series of hearings that we're going to focus on jobs and job creation in the country. And I want to start by talking about a time-tested formula that always works. Less regulation plus less taxation plus less litigation equals more innovation and more job creation. It's a formula that we need to grow this economy to give American businesses and manufacturers the certainty that they need to expand and to allow the U.S. to be successful when they compete internationally. If you go back and listen to some of the testimony that we had in Mr. Guthrie's manufacturing briefing last week, you see from these manufacturers how difficult it is to be globally competitive and create jobs when the Obama administration basically has their boot on the neck of innovation. We've seen nothing but regulatory explosion from this administration. Let me give you an example of this. Just last year, the Obama administration issued close to 4,000 burdensome and restrictive new regulations. In 2011, the Federal Register printed nearly 80,000 pages of new and additional regulations. The federal government has over 291,000 regulatory agency employees. Total cost of federal regulations is estimated to be at $1.75 trillion annually. Now, keep in mind, that's about twice the amount that the IRS collects in federal income taxes. Just this morning, Gallup released a poll where an overwhelming majority of small business owners were surveyed. 85% indicated that they are not looking for new workers. Asked why, 48% of those that were surveyed said they're not hiring due to concerns about possible rising health care costs, the uncertainty of Obamacare. 46% said they were worried about new government regulations. With what we saw last year, is there any wonder that they are worried about that? I think this is one of the reasons that we also are seeing our labor force participation rates at the lowest level that they have been in recent memory. It's more than just health care and regulations, and I am looking forward to our witnesses and to hearing what you have to say today. I yield back.
I thank the gentlelady. The chair now recognizes Mr. Bass for 1 minute.
Thank you, Madam Chairman, and thank you for having this important hearing. I think it's important, over and above the very cogent remarks of my friend from Tennessee, to remember that it is important for, in addition to low regulation, low taxes, it's important to promote, firstly, the creation and growth of small businesses in this country, and I know we'll be dealing with these issues on the floor of the House in the next couple of weeks. It is also very important not to close our borders to free trade. In my state, 1 out of every 4 jobs in New Hampshire is directly related to our state's ability to export its products beyond the borders of the United States. It is important also not to fall prey to the idea that we can tax companies into staying in the United States. What we can do is hold business in the United States by making them competitive and giving them the ability to trade their products across our national borders. And with that, Madam Chairman, I thank you for the hearing and yield back.
Thank you, Mr. Bass. The chair is pleased to recognize Mr. Waxman for 5 minutes.
Thank you, Madam Chair. Thank you for holding this hearing. And focusing attention on job creation and economic growth, which should be our immediate priorities, and I hope this hearing will contribute to this effort. At last, we're starting to see promising news on the jobs front. The number of unemployed Americans has declined by more than 1 million in the past 6 months. Yet too many Americans are still out of work, and we must do everything we can to ensure that job numbers continue to improve. The financial crisis that ripped through our economy in 2008 was the worst our country has faced since 1929. These two events have much in common. Both were brought about by excesses of Wall Street. Both resulted from asset bubbles. Both followed periods of reckless deregulation. As my colleague, Mr. Butterfield, indicated, when President Obama took office, he inherited an economy that had already shed 3.6 million jobs and was losing 800,000 more each month. In addition, he faced paying for 2 wars that added billions to our national debt. No one action turned the economy around or can turn the economy around, but efforts including the Recovery Act, the rescue of General Motors and Chrysler, and billions of tax dollars in tax relief to working Americans have helped. Although factors such as what might go on in the European debt crisis could change our trajectory, the U.S. economy is on the right path. But we won't have a full recovery until unemployed people can find work. And we know the economy is growing and that in economist terms the recession is over. But while this may be a lagging indicator, our focus has to be on getting people to work. I know some Republican members think we need severe cuts in the federal budget that put gaping holes in our safety net while giving tax breaks to the wealthiest Americans. But that is the American equivalent of medieval bloodletting, a cure that makes the disease worse. In the aftermath of a recession like the one we have just experienced, with 12.8 million Americans still unemployed, more than 42% of the unemployed for 27 weeks or more, just leaving the economy alone and cutting federal spending is not an option. I'm pleased that we're going to have a conference agreement on extending the payroll tax cut, paying for some more unemployment benefits, and keeping the promise to the seniors under Medicare that their doctors will be paid so they could people still get access to those physicians. But Congress needs to work with this administration on long-term adjustments that must be made to ensure that the U.S. economy is one that rewards fair play and hard work. The recent budget by this administration for fiscal year 2013 shows its commitment to restoring middle-class security by attacking wasteful spending and instead investing in education, innovation, and infrastructure, the building blocks for an economy that works for all Americans. I appreciate this opportunity to make this statement, and I yield back my time. Thank you.
Thank you, Mr. Waxman. Today, we turn our attention to 4 very knowledgeable witnesses joining us. Each of our witnesses has prepared an opening statement that will be placed in the record. Each of you will have 5 minutes to summarize that statement in your remarks. Our panel today includes Harold Serkin, Managing Director of Boston Consulting Group, John Berlau, Director, Center for Investors and Entrepreneurs at the Competitive Enterprise Institute, John Abowd, Edmund Ezra Day Professor of Economics at Cornell University, and John Schmidt, Senior Economist, Center for Economic and Policy Research. Good morning, gentlemen, and thank you all for coming. You will again be recognized for 5 minutes. To help you keep track of time, there are the lights on the table in front of you. When the light turns yellow, you will have 1 minute to finish your remarks. Please remember to turn the microphone on when you are ready to speak. And Mr. Serkin, we're pleased to recognize you for 5 minutes.
Chairman Bonomack, Ranking Member Butterfield, and other distinguished members of the subcommittee, good morning, and thank you for the opportunity to testify on where the jobs are. While many negative comments have been made about the state of U.S. manufacturing, I'd like to paraphrase Mark Twain and say, the death of U.S. manufacturing has been greatly exaggerated. We've heard the pronouncements of the death of U.S. manufacturing many times before. In the 1970s, conventional wisdom said Japan Inc., with its low-cost cars, televisions, and other manufactured goods, was going to wipe out U.S. manufacturing. Americans were going to be farmers and bankers. Children were sent to schools to learn Japanese, the language of their new masters. But that didn't happen. In the 1990s, conventional wisdom also said that the Asian tigers from Hong Kong, Singapore, South Korea, and Taiwan were going to wipe out U.S. manufacturing. But that didn't happen either. And in the past decade, conventional wisdom has said that China was going to wipe out U.S. manufacturing. And that's not going to happen either. Why? Our economy is designed to respond quickly to threats, unlike any other economy in the world. We're not a country that protects, we compete. Our internal competition is fierce. Companies are forced to be competitive or die. And the results of all this competition are breathtaking. The U.S. produces 2.5 times as much manufactured value add than we did in 1972. And we do this with 30% less labor. We're among the most productive economies in the world, far more productive than Germany and Japan. Each time we're attacked, we don't give up. We respond, we adapt, and we thrive. It is what we are as a nation. The threat from China is large, a nation of 1.3 billion people with a non-democratically elected government that can move fast and subsidize industries. And when China entered the WTO in 2001, wages in China were only 58 cents per hour on average. At that rate, outsourcing to China was a no-brainer decision for many companies in many industries. But the economics of China are rapidly changing. Wages are rising at about 15 to 20% a year. The yuan, a controlled currency, has been rising at 4% per year, and most economists believe would be rising even faster if it wasn't controlled. And while productivity in China is rising at 7% a year, an incredible pace for any economy, it's swamped by wage and yuan increases. And today, the average U.S. worker is 3.4 times as productive as the average Chinese worker. The tide is turning in favor of the U.S. China is just getting more expensive. Companies that went to China for ultra-cheap wages are finding it not so cheap, and they're beginning to rethink their decisions. We project that at some time around 2015, we will reach a tipping point for 7 key categories of goods where the cost to produce in China will be just 10% lower than in the U.S. While 10% is a very important difference to companies, when you include all the costs associated with producing in China to serve the U.S. market, like transportation to ship the goods, the inventory costs for 2 to 3 months of shipping, the risk of obsolescence, and intellectual property capital theft, and country risk, and just being 5,000 to 7,000 miles away from the customer and not understanding their needs, the 10% differential disappears. These 7 categories include computers and electronics, appliances and electrical equipment, transportation goods, plastics and rubber, machinery, furniture, and fabricated metals. These account for 2/3 of the $300 billion we import each year from China. In June, we estimate the impact, including the manufacturing multiplier, would be about 2 to 3 million jobs over the decade. Given what we've seen since June, we believe our estimate is conservative because we've seen far more reshoring from China than our models predicted. Companies like NCR, Ford, Coleman, Nat Labs, and many others have reshored. We're also seeing companies from Japan and Europe recognizing that they can produce much more economically in the U.S. for consumption in the U.S., coming to the U.S. And many of them are considering the U.S. as an export base. Companies like Siemens for power turbines, now exporting to Saudi Arabia, Rolls-Royce for jet engines that will appear around the world, and Toyota are seeing the U.S. as a low-cost manufacturing location. Once again, our amazing economy is responding. Once again, manufacturing is growing in the U.S. because of our underlying advantages. While this is just taking hold now, government policy can help accelerate the trend. Whether it's providing funds to train American workers, reforming our tax system, or finding ways to level the playing field with our competitors, our government can make a difference. Creating more good-paying jobs is something that all Americans, whether they're Democrats, Republicans, or independents, can agree on. We all need to work together to create good jobs for our children and their children and ensure that our economy remains strong for generations to come. Thank you.
Thank you, Mr. Serkin. Mr. Berlau, you're recognized for 5 minutes.
Chairman Bonomack, Ranking Member Butterfield, and distinguished members of this subcommittee, thank you so much for inviting me to testify on behalf of my organization, the Competitive Enterprise Institute, in this hearing asking the important question of where the jobs are. In answering this question, I will focus not on particular locations or industries, but rather on the characteristics of the firms that for the past few decades have been most responsible for job creation. The respected Kauffman Foundation in Kansas City, Missouri, has done some convincing research on this question, and its findings have been embraced by many in public policy, including President Obama's Council on Jobs and Competitiveness. And on a net basis, the bulk of where the jobs are or have been created is at young firms of all sizes. As noted by the President's Jobs Council report, over the last 3 decades, young firms less than 5 years old have created 40 million new jobs. Especially important among these companies are innovative high-growth firms referred to as gazelles that are found to both double their revenues and employment every few years and are found in every sector and every region. Unfortunately, a series of adverse financial regulations have stunted these young firms' growth by making it much more difficult for them to access capital through means such as launching an initial public offering. Now, some of these rules, like Dodd-Frank, have been enacted in the past couple years, but others, like the Sarbanes-Oxley Act of 2002, were promulgated, ironically, in the supposed deregulatory era of the last decade. As the President's Jobs Council notes, of Sarbanes-Oxley and other rules enacted in the aftermath of the Enron implosion, well-intentioned regulations aimed at protecting the public from the misrepresentations of a small number of large companies have unintentionally placed significant burdens on the large number of smaller companies. This regulatory overhang explains part of the slower than expected recovery. According to the Treasury Department's IPO task force, the long-term decline in the number of IPOs, a decline that began more than 5 years before the financial crisis hit, may have cost the economy as many as 22 million jobs not created over the past decade. Now, the good news is there is an emerging bipartisan consensus on scaling back some regulations that specifically burden these firms. In fact, in 1 week in November, this House passed 4 bills with more than 400 votes for each measure to ease regulatory barriers to accessing capital through online social networking and general advertising to venture capitalists and angel investors. But despite the near unanimous support for these measures in this body, they still linger in the U.S. Senate some 3 months later. Now, also tomorrow, your colleagues in the House Financial Services Committee are slated to mark up H.R. 3606, the Reopening American Capital Markets to Emerging Growth Companies Act. This is a bill with widespread bipartisan support that is designed to smooth the IPO process for these young firms by a 5-year exemption from some of the most onerous provisions of Sarbanes-Oxley, Dodd-Frank, and other burdensome rules. Given the ingenuity of American entrepreneurs and the broad-mindedness of investors who fund them, clearing away irrational regulations might very well lead to a future hearing entitled Where the Jobs Aren't. This House has passed some essential access to capital bills, and the Senate needs to be told to, in the phrasing of the President, pass these bills now. Thank you again for inviting me to testify, and I look forward to answering your questions.
Thank you very much. Dr. Abowd, you're recognized for 5 minutes.
Chairman Bono Mack, Ranking Member Butterfield, members of the committee, thank you very much for this opportunity. I'm an economist, but I'm also a teacher, and we don't do our talks without pictures, so I brought some pictures, and we're going to play them. And I'm going to hope that my goal is to show you the dynamics of the American labor market work through both the way in which people are hired and fired and the way in which jobs are created and destroyed. And there are some surprising patterns in these creations and destructions and hiring and separations. And I think the first chart that I want you to look at just shows how the recession spread its way across the economy. Starting in 2004, quarter 4, as the graph gets green, that's good outcomes. As it gets brown, those are bad outcomes. And this is the growth rate of jobs spread across the country. So as you can see, the growth rate of jobs basically went south after the recession started. A more telling measure is what we call stable jobs, which are jobs that last for a full calendar quarter. And this one shows that those also went south, not when the recession started, but after the recession had been underway for a while. So there's 2005, mostly green, 2006, 2007. There's the start of the recession. There's 2008, the fourth quarter, when it really kicked in. 2009, 2010. It hasn't come back very much. What's happening? Well, what's happening is that employers have basically stopped hiring into these stable jobs. So I'm going to skip figure 3 and go straight to figure 4 here. this is the rate at which employers hire into these long-term stable jobs. And as the economy progresses from 2004 through to 2010, you can see that here's the start of the recession in 2007. And right here in 2009, the recession has already ended, and the hiring rate is at the lowest level of any of these graphs that I've shown you. And then in 2010, it's basically not come back very much. The latest data that you can do for jobs that last 6 months is basically 2010 quarter 4, when the Census Bureau releases the quarterly workforce indicators in a few months, in a few more weeks rather, for the current quarter. We'll have 2011 quarter 1. So it's important that employers have stopped hiring into these stable jobs. In addition, the creation rate of these stable jobs, which is the next figure, figure 5, slowed early on in the recession. That's the separation. I need creations, number 5. That was right, yep. What the creations show is that the creation rate didn't slow nearly as much as the accession rate. So jobs were being created. They're being created pretty much continuously, but they slow down during the recession, and they slow down a lot right after the recession, and then come back up in 2010 a bit. Right. So we have both that there's less hiring and that there are fewer creations. On the flip side, there are also more separations and more destructions, but not nearly as many as you think. Most of the downturn in the economy wasn't accomplished by massive amounts of job destruction and massive amounts of separation. Basically, the separation picture, green is now good still, so it's the negative of the separation rate. The separation rate didn't tank, as you can see from these figures. All right. Green is good. And the next figure, 7, the destruction rate didn't tank. Tank is the technical term for head south. All right. As you can see, it stays mostly green in the economy, indicating that the jobs weren't being destroyed at massive rates, these stable jobs, compared to the rates at which the hiring went down. So what went wrong, if you'll skip straight to figure 10, what's gone wrong is the rate of movement in the economy, the ability of workers to move around and to get to new jobs where they're created, that has seriously gone south. It's at very low rates, and generally that churning rate isn't cyclical. So the fact that it's been so low in this recession is a serious issue for the labor market to recover. As you can see, it went very brown in 2009 quarter 4, and it's still very brown in 2010 quarter 4. If the workers can't move around to find the new jobs, and if the businesses can't adjust to find the new jobs, this excess separation, this excess reallocation won't occur. And the biggest benefit of the recession, to move high-valued labor into high-valued jobs, doesn't happen. So what I urge you to do is to promote policies that will put the fluidity back into the labor market and to get this churning rate going again. Thank you very much for your time.
Thank you. And Dr. Schmidt, you're recognized for 5 minutes.
Good morning, Chairman Bono Mack, Ranking Member Butterfield, and distinguished members of the subcommittee. Thank you for inviting me to testify this morning. My name is John Schmidt, and I'm a senior economist at the Center for Economic and Policy Research, where I specialize in labor market issues. The labor market is in a stronger position today than at any time in years. The unemployment rate is down to 8.3% from a peak of 10%, and the private sector has created 3.5 million jobs since March 2010. The American Recovery and Reinvestment Act has played an important role in this turnaround. According to the Congressional Budget Office, the Recovery Act is responsible for saving or creating 1 to 3 million jobs in 2010, 900,000 to 2.7 million jobs in 2011, and 400,000 to 1.1 million jobs this year. As many economists said at the time, the biggest problem with the Recovery Act was simply that it was not big enough to address the size of the jobs crisis we face. measures of long-term unemployment, underemployment, and what my colleague Janelle Jones and I refer to as long-term hardship have barely improved at all in the recovery. Sustained high unemployment has led some to suggest that structural problems are the biggest barrier to reigniting job growth. I believe this view is mistaken. The two most commonly cited versions focus on extended unemployment benefits or an alleged mismatch between skills workers have and the skills employers need. On unemployment benefits, the best evidence, however, suggests that the unemployment insurance system increases the average duration of unemployment by only a few weeks and increases the overall unemployment rate by only a few tenths of a percentage point. At the same time, unemployment benefits also inject income into communities, sustaining consumer spending as well as private sector employment. One recent estimate, for example, suggests that a $45 billion extension in unemployment benefits for 2012 could create 500,000 jobs this year. Nor is skills mismatch a serious structural barrier to growth. Media accounts sometimes feature employers who want to expand but just can't find the right workers. The data, however, provide little evidence that these anecdotal experiences are widespread. If skilled workers were in short supply, we would expect to see two things. The first is an increase in the hours worked by current workers as employers use their existing workforce to meet rising demand. In fact, average hours remain below their pre-recession levels. If skills were in short supply, we would also expect employers to raise wages in order to attract the kinds of workers they need. This is basic economics. When something is in short supply, its price goes up. In fact, again, we see no signs of rising wages in the economy. The real barrier to faster job creation at the moment is a lack of demand. The economy is currently operating substantially below the limits set by the existing capital stock and the available supply of labor. The binding constraint is not the productive capacity of the economy, but rather a lack of demand in the economy for the goods and services that we are already capable of producing. What the economy needs are continued efforts to sustain and restore demand. In the short and medium term, government deficits are an important tool for getting the economy back on course. A large-scale jobs program built around repairing our physical and social infrastructure would be ideal. Short of that, however, three immediate measures would help. First, an extension of the unemployment benefits. Second, an extension of the payroll tax cut. And third, increased federal support for state and local governments. The labor market is looking brighter now than at any point in years, but enormous challenges remain. The way forward requires measures that will sustain and spur private sector demand. Thank you very much.
Thank you, Dr. Schmidt. I thank you all very much for your testimony and your expertise in these areas that are interesting to us all, and I recognize myself now for 5 minutes of questioning. And my first question is to Mr. Sirkin. You mentioned in your written testimony 7 categories of goods that will see only a 10% pure cost advantage to manufacture in China. Why aren't other categories, such as apparel and footwear, subject to the same narrowing of the cost gap and therefore candidates to be manufactured in America?
Well, the goods that we're talking about generally have a moderate amount of labor, so about 25% labor involved. If you go to shoes and apparel and categories like that, you're looking at more like 60, 70% labor. So it may, in the long term, come back to the U.S., but over the next decade, it's unlikely for many of those to come back to the U.S.
And would it surprise you that a constituent in my district, Ms. Liat Tala, moved her manufacturing from China to California to produce her brand of apparel and blue jeans, even as she faces downward pricing pressure? And is this atypical for what we might expect for the apparel industry, or does it validate your analysis of the improving cost and quality differential to make products in the U.S.?
Well, we're going to see examples of many different things happening, and on the premium side, we're going to see apparel companies potentially coming back to the U.S. for reasons other than the exact cost, but because of the need to have a very short supply chain. I'm very pleased that she's trying this. I think it's a wonderful thing for our country, and we need to have more entrepreneurs doing this. And if she's producing at a premium price, it'll probably work quite well.
Thank you. I'll pass along your words to her.
Thank you.
Your report concludes the cost gap of manufacturing some goods in China will continue to narrow significantly enough so that U.S. companies may be able to manufacture their products in the U.S. again without loss of comparative advantage. I understand that this is based on rapidly increasing costs in China, including labor, land, and energy. What are the costs affecting decisions to manufacture in the U.S. that are prone to increasing and therefore disrupting your analysis? For example, additional regulatory costs or higher energy costs, higher taxes?
Well, a lot of those costs are obviously going to be decided on government policy, so it's hard to know exactly what will be the rising costs and what won't. We're certainly in a time of uncertainty. But the ones that you mentioned are clearly things that could affect it. Yeah, I think the biggest driver, though, is the Chinese wage rate increases. The reality is they've overstimulated their economy. They have controlled their currency, and what they're seeing is 15 to 20% wages growing a year, and that is the real thing that is going to help us in many ways.
All right, thank you. And moving now to Mr. Berlau. It sounds like the President's Job Council report has some good bipartisan ideas. Has the President, or even Congress for that matter, followed any of them?
Well, yes and no. One of the council report recommends approval of the Keystone Pipeline, for instance, and the President recently delayed that. But I would say on access to capital, the President has endorsed the concept in the House bills that have passed, such as crowdfunding, which is making it easier to raise funds through online social networks, and exempting from some of the SEC red tape and other things. I think they specifically, the administration specifically endorsed one of the bills and the concepts in some of the others to make public offerings easier and similar items. The issue is that it's somewhat puzzling because these bills, these four bills in November passed by more than 400 votes. One of them literally had one vote against it, but they've been lingering in the Senate for the past 3 months. So yes, we've seen progress in the House. We've seen the President embrace some of these bills. You've got Republicans and Democrats endorsing H.R. 3606 as far as the on-ramp for public firms, exempting them from some of the regulations from Sarbanes-Oxley and Dodd-Frank their first 5 years after being public. But just the Senate, these have just been lingering and with no sign that they're going to be brought to the floor.
All right, let me jump ahead because I have only less than 1 minute left. Several critics, including your co-panelist, Dr. Schmidt, argue that the stimulus was not big enough and that the government should consider a second round. Would you like to speak to that? What is the opportunity and cost associated with such an action?
Yes, I think you're right that opportunity cost is always an important economic concept. What could have been done instead of the stimulus to bring back the economy very rarely is the choice between taking one action and doing nothing. The stimulus, the cost of the stimulus means there's less money to do things that would be truly bring back a vibrant economy, like cutting some of the highest corporate tax rates in the world. And also, there's been interesting new data from the Mercatus Center of George Mason University that 42% of the jobs in the Recovery Act were actually for those already employed. So there's some doubts about the stimulative effect.
All right, thank you. My time has expired, and I'm pleased to recognize Mr. Butterfield for his 5 minutes of questioning.
Thank you very much. I want to spend just a couple of minutes talking about regulatory uncertainty. Ms. Blackburn, in her opening remarks a few minutes ago, opined that employers aren't hiring because of regulatory uncertainty, and certainly we on this side of the aisle agree that regulation should be reviewed and streamlined where possible. However, it is misleading to suggest that regulatory uncertainty has anywhere near the same importance in explaining unemployment as the massive effect of this recession on aggregate demand. Bureau of Labor Statistics data tracking mass layoffs from 2007 to the present support this conclusion. These data showed that among employers forced to undertake massive layoffs, less than 0.5% cited government regulation or government intervention as the reason for the layoffs. By comparison, a plurality of anywhere between 29 and 39% of employers cited lack of demand. And there was no statistical difference between employer responses during the Bush administration and the present Obama administration. Let me go to you, Dr. Smith. Could you please discuss the extent to which you believe regulatory uncertainty has slowed the recovery?
I think that regulatory uncertainty has probably played a very little, if any, role at all in the current situation we're facing. We can look at the historical experience of the United States at the end of the 1990s, which in some people's mind was a period of higher, greater levels of regulation and regulatory uncertainty, say, than the 2000s, even up until 2007. And that was a period of extremely rapid economic growth and extremely rapid job growth, in fact, the highest rate of job growth in the last 30 years. By contrast, if we look at the recovery in 2001, from the 2001 recession, we saw private sector job growth is actually slower than private sector job growth in the current recovery. So I don't think that there is certainly an opportunity for anecdotal experiences of people running into problems with particular pieces of legislation, but there's a regulation. But there's not any evidence that it's a macroeconomic effect that dominates the situation.
Let me try, Mr. Serkin, on my second question. In your testimony, sir, you mentioned that companies from other countries are recognizing that they can more efficiently produce for the U.S. market by locating their manufacturing in the United States. Some are even using or considering using the U.S. as an export base. Number one, can you or any of the other witnesses discuss what parts of the U.S. manufacturing sector are growing? For example, is it in automobiles, electronics, or power turbines, or the like? Mr. Serkin?
Yes, we're seeing this. The U.S. is a very productive nation. We are about a third more productive than Germany, than Japan, and about 25% more productive per worker than Germany. So we are very productive. At the same time, given the currency shifts, the U.S. worker is earning lower wages than in those countries for similar tenures. That makes the U.S. a very attractive place for companies to produce. At the same time, we are the world's largest market. And so if I can manufacture in Japan or in Germany, I may choose to manufacture for U.S. consumption in the U.S. because it is fundamentally cheaper and I will be more competitive. At the same time, when I do that versus producing in, let's say, Germany, I may have the opportunity to export. And if my factory in the U.S. is more productive and lower cost, it makes sense to be producing in the U.S. So we have an opportunity here because of the economic conditions that we see that will allow foreign companies to produce in the U.S., and we welcome them. We do not discriminate against foreign companies in our country. And at the same time, in the example of Siemens for Saudi Arabia, we're exporting, Siemens is exporting 6 power turbines to Saudi Arabia to generate electricity from natural gas. When
you say we are strong, does that include assembly plants as well?
There's assembly plants, and then there's, of course, the supply chains that go with it, because the U.S. is also lower cost. Consider Rolls-Royce manufacturing jet engine parts now in the United States because the cost to manufacture in the U.K. or in Europe is far higher.
Can you discuss whether these plants are mostly assembling parts that are made overseas, or are the parts being made more and more here in our country?
Well, as we saw in the automotive business, when the Japanese came to the U.S. and the Koreans are coming to the U.S., what happens is originally they become assembly plants, and then the suppliers come over because the economics are better. It does take some time for that to develop, but we expect to see that in all these other industries.
All right. Thank you. I yield back.
Thank you, Mr. Butterfield. The chair now recognizes Dr. Cassidy for 5 minutes.
Dr. Vald, I'm also an academic, so my gosh, it's just fun to see PowerPoints, you know what I'm saying, and those are very nice ones. I couldn't help but notice there seemed to be a strong correlation with green wherever it was something I would consider an energy state. Oklahoma, for example, my state, Louisiana, if you take out Hurricane Katrina effect, Texas going up that sort of belt in the Midwest. So can you comment upon the impact of development of our domestic oil and gas resources and its effect upon the job market, particularly for those blue-collar workers who've had the hardest time with employment?
Certainly, I'd be happy to comment on it. We won't play the slides again. The point that I was trying to make, and I think the point that you picked up with the slides, is that the geographic variability in the way the recession moved through the economy and the way the recovery is moving through the economy is very striking. And so you could see that at the start there was already much more activity in the South and over in the Southwest and up in a particular part of the Atlantic coast, and in the North, and in particular in the Northern Midwest, there wasn't. And those are long-term kinds of patterns in the economy. So when there's a vibrant labor market, what happens is that the job creations are where the economic profit opportunities are highest, and those have to be allowed to play out, and the workers have to be able to get to those jobs. The businesses have to be able to create.
So I understand your point regarding churning. My point, the geographic distribution seem to be strongly related to where there is domestic oil and gas production. So, for example, both Louisiana, Oklahoma, Texas had the good green most of the time, and going up through Colorado, North Dakota. Is that my imagination, or is that true?
It's not your imagination, but I'm not willing to attribute it to natural resource production, although that's certainly a possible cause. I'm very reluctant to use the colors to do a specific analysis.
Maybe associated but not causal.
But things like that are.
Mr. Schmidt, your thing is hidden by you may be a doctor, I can't tell because of the water pitcher, I apologize. I'm struck that we have a problem with blue-collar unemployment, and yet the President continues to speak about hiring more teachers and solar engineers, and you frankly kind of echo that. It seems a strange way to hire blue-collar workers is to put more money into programs which basically you have to have a PhD sometimes in order to qualify for. So there seems to be a mismatch there. How would you explain, how would you defend, if you will, more Solyndras when our problem is blue-collar workers?
I think that a key issue in terms of addressing the problems of blue-collar workers is to try and get at the kind of infrastructure kinds of issues. I think that's where we have an opportunity.
And you define infrastructure as?
Infrastructure, transportation, improving.
But you specifically talk about, putting more money into public service type employees, which again, I don't think of those as the people who are currently being whacked by the recession.
No, I think that the impact of the recession has been pretty broad, and I think therefore we need to use a kind of broad.
But I'm correct when I say the blue-collar workers, particularly non-college educated men, have been disproportionately affected, whereas those with bachelors and upwards are frankly doing okay.
I wouldn't say they're doing okay, but they've fared better in the recession than.
So again, if the prescription, and I'm just asking, I don't mean to speak with compressed speech, but I have limited time. If the prescription the President continues to offer is more kind of, okay, let's go to somebody who makes solar panels and hires a bunch of PhDs and engineers, or let's hire more teachers or keep them employed, that seems the mismatch, if you will, between those who are disproportionately affected by this recession.
I think that, on the other hand, it is also the case that there is an emphasis on trying to deal with the physical infrastructure, whether it's roads and public transportation, or improving the physical infrastructure of our schools, where I think there is a big opportunity for blue-collar workers.
Now, you mentioned also in your testimony that the mean hours worked by employees and the mean wages remain stable. Is that an average across the economy, or is that industry-specific?
Yeah.
Because if you look at petrochemical, where there's been a huge expansion, and they tell me that they don't have enough trained workers for it, that if you looked at that, do you see within that particular industry that there has been an increase in number of hours per worker or wage growth?
I don't have access to the specific statistics on petrochemicals, but what I would say is the numbers that I did talk about are averages across the country, and I don't doubt that there could be circumstances where there are some industries that are facing difficulties. My question would be, do we see those same firms offering more money or installing training systems to try and get the workers that are there?
Yeah, and that's my question, too, because if we're trying to find solutions for blue-collar unemployment, we should look where they're being employed. And again, frankly, I think more public service dollars is kind of a mismatch. I yield back. Thank you.
Thank you very much, Dr. Cassidy. The chair is now pleased to recognize my friend from Texas, Mr. Gonzalez, for 5 minutes.
Madam Chair, thank you very much, and I want to thank the witnesses for their testimony this morning. Doctor, is it Abowd? Abowd. I'm going to kind of, what I heard you say, and if I'm wrong, you can correct me, but in essence, jobs go where profits can be made. That's kind of a general theory, isn't it? And it makes sense. It's practical and so on. Jobs are created where a profit can be made. I mean, you're not going to create a job where you can't open the door to your business in the morning unless a profit is made. I think that's just what I'm getting at is I think, in my own opinion, and I want you all to comment on this because I'm going to go in and read a couple of comments made by a couple of individuals that you've heard of. I think there's something, the very nature of our economy is in trouble and has been transformed over a number of years, and we're not going to be undoing it in the very short term, and it's time for us to get very, very serious about undoing it. And this is what I'm getting at. This is David Stockman back in 2010. The third omnibus change in the American economy has been the vast expansion of our financial sector. The combined assets of conventional banks and the so-called shadow banking system, including investment banks and finance companies, grew from a mere $500 billion in 1970 to $30 trillion in September 2008. That's David Stockman. Now, some figures, our GDP a year and a half ago or so, let's say, was at about $14.601 trillion. The total assets of the Bank of America, J.P. Morgan Chase, Citigroup, Wells Fargo, Goldman Sachs, and Morgan Stanley stood at $8.977 trillion, or 61.49% of GDP. In the 1970s and 1980s, financial firms comprised 15% of all corporate profits. By 2006, that had risen to 33%. I believe we've just been investing in money. We've been investing in financial instruments and not really investing in that which truly creates jobs in this country. Now, some commentators would agree with this. And now, former Fed Chief Paul Volcker, quote, "I have found little evidence the vast amounts of innovation in financial markets have had a visible effect on the productivity of the economy." The question is, where are we directing our dollars, our investments, whether it's my 401, whether it's a pension and retirement fund? I don't think we're investing it in that which really produces jobs in this country. What we got addicted to was making money off of money. And it has not served us well. But I'm not sure that we've moved forward in trying to remedy some of this in the past 2 years. Attempts have been made. So I'm going to start with just Dr. Abad. Where are we today with financial markets and the tremendous assets that they represent? And do they truly create the jobs that all four of you have been discussing, and which members of Congress obviously have great attention to be paid to through policy and legislation? And if you'll just give me about 1 minute and the remainder of the time to Dr. Schmidt for his comments.
Thank you for the question. I won't take very long with my answer. I did prepare a slide on the financial sector that shows that it was also one of the sectors that suffered stable job losses in the recession, but not nearly as badly as the construction sector, which basically is the bubble that was inflated by the financial services industry. I fundamentally agree with you that the growth of the financial services industry wasn't entirely related to productive profit opportunities in that sector. It happened, and it happened for reasons that it's going to take economists a while to sort out. But other sectors of the economy, like manufacturing and construction and trade, also have to come back, and jobs have to be created in those places. In all conditions, recessions and booms, there are jobs being created in all the sectors and jobs being destroyed in all the sectors, and that removement of workers is what allows businesses that have profitable opportunities to grow and flourish. The fact that over the course of 2 decades the financial services industry was pumped up by other factors is related, but not part of what I was talking about.
Okay. Dr. Smith, just a few seconds.
The financial sector, I think, is a huge part of the problem. I think if it were a lot smaller, there'd be more possibility for productive economic investment, because we're currently diverting resources that could be going elsewhere into that sector.
Thank you very much.
I think the gentleman in the chair recognizes Mr. Guthrie for 5 minutes.
Thank you. Over here on the end. Hey, Dr. Schmidt, you said, I just caught something. You said that unemployment, you said would increase unemployment insurance as evidence has only increased it by a few tenths. Is that, and that's not significant, the few tenths?
Well, if you're in those few tenths, it's not very, it's obviously significant to you, but a few tenths of a percent on 10%, which is where we stood at the peak, is relatively small, and that's the negative effect on employment. But as I also emphasized, the fact that we're giving everybody, or about 75% of 75% of unemployed people benefits, means that we're actually sustaining jobs in communities where those unemployed people are, because we're giving them income to bridge the gap.
My question, it seems there's been an agreement to extend those. But so I guess my question was, if unemployment increases at just a few tenths, and that's not significant, then for the last 3 or 4 months, we've seen unemployment drop just a few tenths, which, we are glad to see we're going in the right direction. Is that insignificant? I mean, if you're saying increasing it a few tenths isn't important, then decreasing a few tenths, is that as substantial?
No, as I said, I think we've made some progress since August. The unemployment rate's gone from 9.1 to 8.3, which is more than a few tenths than what I'm saying right now. But I also emphasize we are not out of the woods. I think we have a long way to go before we get back to anything approaching full employment. Yeah,
that's what we're all here talking about. We want people to get back to work. So one of the things that I saw this a few weeks ago, I guess, is that if you took the growth rate coming up, my father lost his job in the 1981-82 recession, so that's one that I remember, and Japan and Toyota. My dad worked for Ford. So those were our experiences. And so I've heard that if we had the same growth rate in year 3 or year 4, I think we're in year 4 now, but year 3 of the same growth rate of year 3 of the 84 recession or 82 recession now, then we would have over 10 million, or somebody even said 15 million new jobs. If you can cut that by 2/3, because that seemed a big stretch, we'd be at full employment if we came out of if we were 3 years into the recession with the same growth rate out of the 82 recession, we would have full employment today. Is that anybody seen that or agree with that or disagree with that?
If I may, there is some evidence that IPOs are actually countercyclical. That when the debt market is tight, as it was in the early 90s recession with the S&L collapse, IPOs actually increased. There were actually more than 300 IPOs in 1991, and that's where you had companies that were relatively small, like Starbucks and Cisco Systems, unlike the big IPOs today, that launched. They were able to utilize that process when they couldn't get debt, when they couldn't get bank loans, and that's what's been credited with helping going from a recession in the 90s to the boom. But now a lot of these options are foreclosed because of the Sarbanes-Oxley auditing mandates and Dodd-Frank, whereas 80% of the IPOs in the 90s were with companies with market valuations below $50 million. Today, only 20% are.
Okay. And I want to get to a point, though. What I was getting at with it, though, is as you moved out of the recession in the early 80s, and then Japan went into theirs in the 90s. And one of my concerns, I was a freshman here when we started discussing the stimulus bill. It appeared to be a lot of the same prescription that Japan followed in the 90s, which a lot of people say Japan in the 90s had the lost decade. And so that was the concern. Are we at a point where the American economy has been so adaptive? That's been our brilliance. I mean, in the 1980s, my father lost his job. We're thinking Ford's out and never going to exist like it did before. And here we are, GM's now the #1 selling car again in the world, which is great. But the question is, we haven't recovered that quickly, and are we putting in prescriptions and policies and regulations and borrowing 40 cents of every dollar to have a school teacher in a classroom? Is that hurting our recovery? I know that we're moving in the right direction, but we would move far greater if we'd gone down the path that they did in the early 80s. I mean, that's really my question. And anybody's welcome to that. But I do want to, let me stop with that, because I do want Dr. Abad. You said if we change fluidity policies for labor, what policies would you prescribe then? We only have 40 seconds, so I'm sorry, but that was interesting to me too.
I won't go through a litany list of them, but one of the big differences now from the recessions you were citing is that it happened with a housing price bubble that collapsed, and that definitely impaired the geographic mobility of workers, and also impaired the geographic mobility of new businesses because they were caught up in some of the same financing arrangements. So that's a big difference, and that's something that takes more than a few quarters to cure because of how much lost value there was. So that's
so a manager in Atlanta can't move to Fruit of the Loom in Bowling Green for a job available because they're underwater in their house in Atlanta. Is that where that kind of limits their mobility
to move? That's the kind of thing I'm talking about, yeah.
Okay, thanks. I'm sorry. I wish I had more time. I'll yield back.
Thank the gentleman. The chair recognizes Mr. Towns for 5 minutes.
Thank you very much, Madam Chair. Appreciate you having this discussion. In the State of the Union, Mr. Smith, The President described the blueprint to put Americans back to work. And of course, and when I go back to my district in Brooklyn, New York, people are saying that Congress isn't moving fast enough to create jobs, and I couldn't agree more. If we follow your 4 policy recommendations, what immediate impact do you think we would see in the job market?
I think the immediate impact will be to continue to see some positive job growth in the private sector, could see a continuation in the decline in the unemployment rate nationally. But as I emphasized, if we do just the things that I was proposing this morning, I think we are still facing a very long road to recovery. We need to do more than just those short-term measures. On the other hand, I did mention in my written testimony, not this morning when I spoke, that one thing we could do that could have a long-term big impact would be to get the value of the dollar at a more competitive level, which would help to expand the manufacturing sector by making it more competitive.
Right. Thank you. A few panelists talked about the importance of having a stable job and its impact on consumption and demand. When I go back home, people talk to me about finding a stable job. Traditionally, jobs in manufacturing have been very, very, very stable. Mr. Serkin, can you go into a little more detail about reshoring and things Congress can do to make it more attractive for manufacturers thinking about moving their operation, to other places?
Well, I think there's many things that we can do to make it easier for companies to do that. The first is awareness. One of the problems we have is that companies assume that it's cheaper to manufacture in China than in the U.S. I remember sitting in a boardroom one day with a company that had about 80% of its manufacturing in China, a U.S. company, and they were summarily just putting another plant in China because that's what's logical to them. We forced the question on the table, and their decision changed. So the most important thing that we can do is get awareness that, in fact, the economics of China are changing and that you should be looking at it very carefully, and that you shouldn't just do the math on what it looks like today, but look 3 or 4 years in the future and take a look at it, because you'll find that if you have a plant, it's going to last for 25 or 30 years. And so making a decision today to put a plant in the ground in China may not be the most economic decision 5 years out. So companies need to be just more aware that the U.S. is a reasonable option for the manufacture of many goods. In 2001, the Chinese worker was making 58 cents an hour. It was a very simple decision. It's getting more complicated now, and the tide is turning back towards the U.S. So if I had one thing that I could ask people to do is to just build that awareness. We are a good place to manufacture. It's why foreign companies are coming to the U.S. as well to manufacture for U.S. consumption, because it's more expensive where they are.
Right.
If I may.
Yes, sure, go ahead.
The President's Job Council report and the Kauffman Foundation have stated the findings that in some cases 100% of net job growth are created by firms 1 to 5 years old. Firms older than 5 years old have eliminated on net more jobs than they've created, and 90% of this job growth occurs after an IPO. The problem is there aren't as many IPOs for companies that are emerging growth companies, and you had sponsored some of the early bills to ease some of the burdens on smaller companies, from Sarbanes-Oxley 404. Some of the IPOs we're getting now are already a billion, more than market cap of $1 billion after the growth has occurred. So they need more. Every dollar a company can raise from an IPO is that less that they can have to borrow or beg from a bank, and more that they can devote to creating jobs in the companies most likely to create jobs.
Right. Madam Chair, I see my time is running out, but I would like maybe to ask in writing if you would just sort of make a suggestion, a recommendation as what members of Congress might be able to do, and put it in writing and give it back to us. I mean, I would like to just see that in writing as to what you suggest that members of Congress should do. In other words, let's switch roles. Make me the economist and you a member of Congress.
Glad to.
Be careful what you wish for, Mr. Towns. Chair is happy to recognize Mr. McKinley for 5 minutes.
Thank you, Madam Chair. Mr. Schmidt, I'm just a little astounded with one comment you made. I'd like you to maybe expound a little bit on it before I cut you off. but you said that the uncertainty is really not a factor. I really wish if you could provide us the information that supports that, some statistics, because I'm just looking. I just in scribbling here a list of some of the companies that were in possibly within 20 miles of my home that are no longer. The Banner Fiberboard, Fostoria, Viking, Allied North, Solvay, Wheeling Pitt, Weirton Steel, Follansbee Steel, Purina. There's just numbers of companies that when we talk to them, they say it is absolutely the uncertainty that they're facing. That we've talked about a bill we passed out here earlier this year that the Veritas Group said that without that bill, because of the intrusion of the governmental process, the EPA, was going to cost 316,000 jobs. It was the coal combustion residual bill, the fly ash bill, because the federal government has stepped in and now they're threatening, they've got a stigma attached to all of the fly ash that's being produced around America, and they want to call it a hazardous material. So there's a stigma and uncertainty that's swirling around. All 316,000 jobs could be lost because of this. The aluminum industry, just last week we had a meeting with them, and they told us that it is uncertainty in their utility bills that's causing them not to reopen and operate some of their facilities. They want to know what is going to be our utility costs. We had the EPA back February of last year pull a water permit from an existing coal mine in West Virginia 4 years after it had been in operation. I've never heard of that. It's unprecedented. It's now in federal court, and the courts are challenging that significantly, whether or not that intrusion into the process after a permit's been granted, all the hearings were held, 4 years operation, they have the right to step in and pull a permit and shut a company down? And yet you sit here and say uncertainty is not a problem in America. I'm not hearing that in my district.
I think it's important to distinguish between what kinds of uncertainty, whether you're talking about regulatory uncertainty or whether we're talking about all the forms of uncertainty like exchange rate shifts, changes in the interest rate, how your competitors are going to act relative to you.
Well, let me what your competitors are acting, how they're going to, China, okay? Here we had for the San Francisco Bridge, they didn't use American steel. And it was so flawed that we had to send inspectors over to remake a lot of that steel, but yet because it was lowest price, they were able to buy that from China. Our turbines for our wind turbines are coming from overseas. We've got even the Keystone Pipeline, from what I'm hearing from testimony, that wasn't even manufactured. The steel didn't come from America. What are we doing then about this uncertainty? If you see that this competition is coming in unfairly, and I mean that word, unfair competition coming in, how does that create certainty in the American manufacturer?
Well, I certainly share your concern that the trade agreements that we've agreed to and signed and ratified over the last few decades have created a lot of problems for U.S. manufacturers and for in the particular cases that you're talking about. But I think the other issue to think about is that to a certain degree there's working the ref involved in these kinds of conversations. Any individual firm is going to be talking to the government officials that they deal with and saying, look, we're having trouble here, you got to help us out. When we look at the not anecdotal data, but when we look at the evidence, when we look at the broader data, we see, for example, very rapid job creation in the end of the 90s. And the other issue is right now, corporate profits are at record highs. So the activity that firms are currently undertaking is actually giving a very high return to those companies. Perhaps uncertainty is hanging over businesses' future decisions, but my point is just that the uncertainty around whether they're going to be customers or not far outweighs all of the other concerns at the moment.
We've run out of time, but I've got a lot. So all I'm asking is, please, if you could submit where in God's name you came up with the idea that uncertainty is not a problem to manufacturers. I'd sure like to read it. Thank you very much.
I have an answer on regulatory uncertainty if another panelist wants to ask a question.
Thank you. I too echo Mr. McKinley's sentiments, too. I'm confused myself about your answer, but I'm happy to recognize Mr. Olson now for 5 minutes.
I thank the Chair for her continued leadership in calling this hearing. And I'd also like to thank our witnesses for coming today and giving us your time, your expertise. We're talking about the current obstacles that stand in the way of job creation and discussing the kinds of policies that will help create new jobs right here in America, which is what we all want to do. Doubling down on the failed policies of wasteful stimulus spending has made our economy worse. It's not the answer. And yet, this is exactly what our President's proposing in his 2013 budget. I've said this in the past, and I'll say it again. I'll say it until I probably meet St. Peter. I have a 3-word solution to help fix this nation's anemic job performance: American energy development. American energy development. That's where the jobs are. And so I'd like to start my question today by asking all the witnesses for their view on what they believe to be the main obstacles for the creation of American energy jobs. And specifically, is there one federal agency or specific regulations that, in your views, are hindering job creation in the energy sector? Or, put another way that my folks back home can understand, which stallion do we need to break so we can pull the wagon instead of pulling the wagon apart? I'll start with you on the end, Mr. Sirkin. That's your guy's right.
Sure. Well, I agree with you that American energy development is very important for our economy. Being more energy independent has lots of advantages, both from the economy standpoint and from a national security standpoint. I have not looked at, what is the barriers to making this happen in our country. The economics of it are quite powerful, given oil prices at now looking at Brent oil at least over $110 a barrel. And obviously the natural gas reserves that we now have 100 years worth is a very important aspect of attracting businesses to this country, because we have some very low-cost natural gas, and that's bringing the chemical companies who thought they'd never come back to the U.S., coming back to the U.S. So there's many good things, but what the barrier is, that's not something I've studied.
Thank you for that question. Just to follow up on those comments, so I actually went out to the Eagle Ford shale play in my home state of Texas this past weekend. And just to show you how not only jobs are being created there, but what a tremendous impact it has on the local community, one of our escorts was they have a couple wells in Zapata County, which is a relatively economically depressed county in my home state. The gentleman told us that since they've been the 2 years they've been operating there, the sales tax revenue has gone up 3,000%. The property tax revenue, which is what we use to pay for our schools, has gone up 4,000%. So again, energy is not just about jobs, it's about quality of life. And continuing on with, let's see, number 2, Mr. Berlau, again the question, what agency of the federal government biggest hindrance?
Yes. Well, Congressman Olson, thank you. Regulatory uncertainty is a factor in the energy industry and many other industries. My fellow witness had talked about surveys of firms laying off workers. I think as important are the surveys that much research has been done on firms' factors in whether or not firms expand, whether they launch IPOs. And there you can see that regulatory uncertainty is a big factor. 80% of CEOs of smaller companies said some of their biggest concerns about the implications of going public were the costs and risks of Sarbanes-Oxley and other compliance requirements. And in the energy sector, yes, you have the looming regulations on fracking, on the delays in the Keystone pipeline. But I think in all businesses and in energy sectors, from oil exploration to green energy, it's access to capital that they can't launch, and it takes so long that you have to be as big as Facebook to launch an IPO. And actually, if you simplify some of these regulations, it would be easier both for companies in the green energy sector and into the traditional energy sectors to get the capital they need.
So it sounds like we need to reform the tax code and get our sky-high corporate tax rates down.
Yes, and of sky-high regulations.
There we go. Okay, I'm sorry. I'm Mr. Abowd. Abowd. I apologize for that. I got it written down there, Abowd. My apologies, sir.
Well, I think that the long-term prospects are best if we fix the energy distribution network so that more electricity can be delivered, especially for transportation purposes, stimulating growth in the production of alternative-powered vehicles, which are a huge growth potential. And they're basically being held down by no standardized way to distribute the electricity to them. And that I think would be where I'd look for.
Okay, sir. And finally, Mr. Schmidt, and I'm out of time here, sir, so as fast, quickly as possible.
Please turn your microphone on.
I'm a labor economist and I don't follow the energy sector, so maybe I'll just take a pass.
Okay, I appreciate that. One kind of following up on some of the questions by our chairwoman earlier about mentioning the bipartisan jobs that have been passed by the House of Representatives that are sitting over there wallowing in the United States Senate. I've got an updated list here for all of y'all that just hot off the presses from the Republican conference this morning. I'm happy to give you guys a copy of this. I'm sure our conference will be happy to give it to you so you can pull it out of your pocket like I did. But this is a list of 29 jobs all across our economy, empowering small business by reducing government barriers, fixing the tax code, boosting competitiveness for American manufacturers, encouraging entrepreneurship and growth, maximizing American energy production. Again, I'll get you guys this if you want it. Put it in your pocket, pull it out, do it, use it just like I did. I yield back the balance of my time.
I thank the gentleman very much and thank all of our witnesses. As we conclude our first hearing of the year, permit me to also thank each and every one of our members for all of their hard work and dedication to these issues, and a special thanks to my friend Mr. Butterfield, who's been a joy to work with. I'm looking forward to a great year. I remind members that they have 10 business days to submit questions for the record, and I ask our witnesses to please respond promptly to any questions you might receive, and the hearing is now adjourned. Thank you.